Well, folks, hi. Welcome to our, what is this, our third Start Smart of the season, How to Form Your Startup Company, Part 1. And I'll do a little commercial for Part 2 in a minute because some of you might have to log off early. So this is all about business formation, and it's sort of the basics, the 101s about what types of what your options are, what are the pros and cons of each, what are some of the subtleties about, and depending on what you pick will go into your bylaws or your operating agreements, and lots of opportunity to ask questions. So again, I'm Kit Needham. I'm with Carnegie Mellon, Project Olympus, Assistant Dean for Entrepreneurship Initiatives. And so we help startups at all stages, at all types, from anywhere, undergraduate through PhD, faculty, staff, alumni, explore the commercial potential of their idea. So we do this jointly with my partner in crime, Stephanie Dangel, who will introduce herself.
I'm Stephanie Dangel. I'm a professor of practice at Pitt Law School. I've been doing this with Kit and David for over 10 years. I won't say exactly how many, and I've known David for over 20 years. I won't say how many. But I teach courses in transactional drafting, entertainment law, commercializing new technologies, and Wicked Problems Innovation course, in addition to running our externship program. But this is always one of my favorite seminars and workshops because the law students have an opportunity to work directly with the entrepreneurs, and the entrepreneurs walk away with a legal roadmap, giving them some suggestions that they need to think about with respect to entity formation.
Okay, and this production is produced and made available to you courtesy of Jess Melandro. You want to introduce yourself?
Hello, everybody. My name is Jessica Melandro. I am the manager for student programs at the University of Pittsburgh's Big Idea Center. We're Pitt's hub for innovation and entrepreneurship. So we control all of the student programming that comes out of the Office of Innovation and Entrepreneurship at Pitt. So if you are interested in learning more about that, you can follow us at Pitt Big Idea on Twitter, Instagram, and Facebook. If you don't already, it's an excellent resource, not just for Pitt events, but also for events happening at other universities and throughout the city of Pittsburgh. And just a little plug, we have Global Entrepreneurship Week coming up in November. So be on the lookout for announcements regarding that, because that's a joint effort between us and the fine folks at Carnegie Mellon University and some other partners along the way. So that's my quick plug for things coming up, Global Entrepreneurship Week in November.
Okay. Stephanie touched on this, but just mark your calendar for November 10th. And if you want to participate in Part 2, submit a brief synopsis of what your business is. You'll send it to Stephanie, and Stephanie then will work to pair you up with law students. So the next part is absolutely a workshop. So this is the basics of all the stuff that you need to know or need to figure out. And then the law student will help you with the workshop. And David, before I introduce you, and Stephanie, if you want to introduce your team and so forth, I'm going to do the thing I always forget to do until you remind me. So one of the advantages of having enough people like this available on Zoom is your opportunity to ask for, if you are looking for somebody to join your team, if you want to work in a startup, don't have an idea, but like to join a team or to work with a team for a while, if you have any announcements, or if you need any help, if you're looking for an introduction to or looking for people who know, this is the opportunity. Please do not be shy. This is the way we engage our network. So I'm just going to go ahead and unmute yourself, and then just go ahead and speak up, and I'll run interference if we have too many trying to talk all at once. So who wants to start? Wow, that's a first. Okay. Well, maybe we were having trouble. I was thinking you had trouble on finding you're on mute in there too. I have one thing that I would just want to ask.
Samir has his hand up, right?
Huh?
Samir has his hand up.
Oh, okay. There we go. I knew we would have at least one to get it started. So Samir?
Yeah, I feel bad to move through anything. Hi, my name is Samir. I'm a CMU alum. I work in and live in downtown Los Angeles, and I have a new web platform that's 7 months old called What to Do. Thank you.
And what, are you looking for anything?
Yeah, advice. So I threw together LLC, and 6 months in, I'm learning more. And so I would love to be paired with a lawyer to understand, did I incorporate the correct way? Should I go C-Corp, S-Corp, et cetera, et cetera?
Well, definitely submit your name to be on the workshop on the 10th. So this
Okay.
is exactly what we do. It's free.
Fabulous.
So, but it's high quality is excellent.
Okay, great. We'll do. Is that link in the chat room?
I will, I'll
Thank
put
you.
the link for the next workshop in the chat room as well as my email.
Excellent. Thank you.
And then Jackie, I don't know if you're on board, but if you want to say hi, Jackie Walker is helping me teach the class where we'll be drawing the law students from, who
Okay,
you'll be paired with.
excellent. Hi, Jackie.
Hi, everyone. My name is Jacqueline Walker. I am a lawyer based here in Pittsburgh. I have my own firm. I focus in arts and entertainment law, and I help small businesses get off the ground and operationalize. But I focus mostly on working with the creative class of folks. Focus on contracts with equitable phrasing, like really just trying to make equity a practice and not just something we say.
Well, welcome.
Oh, and I'm a Pitt alum.
Yes.
Like we should.
Nice.
There we go. Got your credentials in there. So David, unless we have another hand raised somewhere that I'm not seeing,
Okay.
I'm gonna turn this over to you.
Well, thank you. And it's nice to see everybody this evening, even by Zoom. My name is David Lehman, and I'm with K&L Gates. I've only been there for 30 some years, embarrassingly so, working with startups, et cetera. I'm going to be joined today with by two of my partners. So let me let them introduce themselves as well, and then we'll get into the presentation. You want to start, Cordy?
Sure. Hi, I'm Cordy Grabiak. I am also at the K&L Gates Pittsburgh office with David. I've been there about a little over 20 years. And my practice focuses on nonprofits and tax exempt organizations. So I'll be talking in a little piece of the presentation about that potential form of organization.
And Odette.
Hi all. Hey, so my name is Odette Green. I'm at K&L for I think 17 years, so I'm younger than Cordy. And I work mainly with emerging growth companies throughout their whole cycle. It's through formation, fundraising, and licensing.
Well, thank you. Let me see if I can share my screen and put up the presentation. If I do this right. Is it up? Can you see it?
And
Cool.
it's not in presentation mode yet, though. You
Okay,
have to
how do I
hit
do
the
it?
little button at the bottom or wherever you find it.
Which one? That one right there? No.
I usually use the one at the bottom.
How about that one?
That's it.
That work?
Yep.
Cool.
Should work. Hasn't
Then I
worked
did-
yet. You have to
I did
press it.
something right today. Cool.
No, wait, it's still in presentation. It's not in presentation mode.
Oh, really?
Yeah, so go back to over where the sound, the size is. There we go. But
Okay,
you
here.
go back to the first page, yeah. Okay, all right,
Is it on? Can you see it?
well, we're still not
Still not.
full screen, but that's okay.
Let's go with this. All right, so we're going to talk about is the choice of entity and the kind of entity that these should be, and we'll talk about for-profits, and then my colleagues will talk about benefit corporations and B corporations and nonprofit corporations. Then we'll talk a little bit about the founder arrangements and what those arrangements should be about among each other, including how to split the pie and the vesting of founders, which is really important. Restricted covenants, what they shouldn't be doing. We'll talk a little bit about operation of the entity, and if we have time, we'll talk about employee equity and providing equity to employees. The one important item before we start is that this can be quite dull if I just keep rambling. So you should feel free to ask questions along the way. I'm sure that Stephanie and Kit will take a look at the and let me know when there's things in the chat room and interrupt me. And you should feel free to just interrupt as well. And with that, we'll start about the choice of entities. And as you can see, this is a list of potential entities. There's a lot of them. And I won't go through all of them. We will focus today on C-Corps or corporations, and those come in two flavors, C's and S's, limited liability companies, and benefit corporations and nonprofit corporations. I should have a star by that. Those are the principal ones. Partnerships, we'll talk about. We don't particularly like those, and sole proprietorships because they don't limit liability, and that's pretty important. So, and the principal thing that people talk about is, oh, should I form a C-Corp or an S-Corp or an LLC? Much like the question was already asked, and so we'll talk a little bit about that. Let me talk about nomenclature for 1 second. Owners of, because these get kind of confusing. Let's break the world into two pieces: corporations and limited liability companies. Corporations, the owners of corporations are shareholders or stockholders. They are the owners. And the corporation is managed. They have a board of directors, and then the board of directors appoints the officers. So you have the shareholders as the owners, and operating the corporation is the board, and they appoint the officers. In the limited liability company structure, that's a little different. Same concepts. The owners, however, are called members instead of shareholders, and the people that operate are often the board instead of board of directors. They're called the board of managers. Same concepts, just different nomenclature. So when people use them, members and shareholders, just their stockholders, just know the same concepts, just in different entities. The it's not advancing, so let me do this. You know, unfortunately, if somebody says to me, well, which entity should I be? The answer is it depends. It really depends on a lot of things, a lot of different factors, some of which we're going to talk about in a moment. I do want to talk for a moment about why form an entity in the first place, because that's really important. And the principal reason is because you limit your liability. And the reason I started by saying that I don't want a partnership is because partnerships don't limit their liability. I liken this to when I go to play blackjack in the casino, and when I put money up on the table, the good news is that I can only lose the money that's on the table. The dealer is not allowed, may not, and shall not go into my pocket and pull out what I didn't put on the table. I may decide to put some more money in, but they can't do it. Well, similarly, we have this wonderful system where if I put money into a corporation, the stockholders, either the stockholders or the members, the owners of the corporation, are generally not liable for the debts and obligations of the entity. It's sort of a neat concept and one that we ought to sort of enjoy, which is that I can play this game out there of running businesses and all that kind of stuff, but at the end of the day, if things go to hell and it goes bankrupt, I personally should not be liable for any of those debts and obligations. That is the reason the principal reason we form entities, to limit the liability of the entity and the enterprise to the amount that's in the corporation. So that's a pretty important concept. So ways to screw that up, which is to make you liable for owners liable for the debts and obligations of the entity, notwithstanding the fact that you formed the entity. Well, one principal one you'll see in the second line of this slide is failing to adhere to the corporate formalities. There's a concept called piercing the corporate veil, which allows creditors of the corporation or the liability company to pierce the corporate veil or go after the members or owners for the debts and liabilities, even though they formed it, because they didn't treat it like a separate entity. They didn't, for example, have separate bank accounts. They didn't sign on behalf of the company. They didn't have shareholder meetings. They didn't have board meetings. They didn't treat it like a separate entity. And if you do that, then it will not be treated as a separate entity, and you are exposed to potentially piercing the corporate veil. So one piece of advice is we're going to talk a little bit about creating an entity, but it's not just filling out the form up front and then forgetting about it. You have to really treat it like a separate entity. One other one that's not on here that I should note that occurred to me when I was going back through here is fraud. If a corporation signs a piece of paper that defrauds somebody, that also the other party can pierce the corporate veil and look to the members or shareholders. So, for example, if you're seeking investment and you say something that you intentionally mislead them, and they put their money in, and you intentionally do so, mislead them, they can look at you personally for that, notwithstanding the corporation. This is why we go through reps and warranties very carefully and make sure that we can't be exposed for fraud. The other things at the last bullet point there are other ways you can become personally liable. One is signing guarantees. Sometimes people, notwithstanding the fact that there's a corporation, you sign a personal guarantee for the debts of obligations of the corporation. For example, you may go enter into a lease. The lease may require a personal guarantee because the company doesn't have many assets, and now you've exposed your personal net worth for that. You may make a decision to guarantee, not guarantee. That's up to you individually, but just know that that's what you're doing. You're exposing your personal assets to the debts and obligations of the company for that purpose. The other one that I want to highlight is unpaid wages and taxes. If the corporation hires people and doesn't pay them, then the officers and directors are liable personally for the wages and the taxes with respect to those employees. Now, there's some stuff around that, but at the end of the day, it's essential that if you hire people, you pay them, and you especially pay the withholding taxes. Otherwise, you are personally liable for that. So if you find yourself getting in trouble, you make sure those are paid first. Let me skip the others for now. I'll keep going. When I talked about keeping the corporate formalities, this is a list of those things. I talked about bank accounts, keeping the money separated in separate accounts. Make sure that you sign on behalf of it. Keep shareholder minutes. Keep the corporate records. Make filings, and I should, it's not that there's a footnote here just to point out that these corporate formalities are good not just for the personal liability, but they also, when investors come in or a buyer comes in, they're going to be looking for these things as well. And so you're also setting the stage to enhance, frankly, the value and make it so that people can invest in your company and you can ultimately sell the company. Well, as exciting as liability is, the only thing I can imagine that's more exciting is tax. So let's spend 1 minute on tax. And the reason I wanted to do this is, if you take nothing else away from this part of it, you ought to understand that tax is important in thinking about how you structure your company. That's the main takeaway, that tax is to be considered. And so let me spend 1 moment on this, because there's a fundamental difference between C corporations, which we talked about on the one hand, and S corporations on the other, S corporations and limited liability companies. C corporations are subject to what's called double tax, which is to say that the corporation pays tax on any money it earns, then it pays a dividend to its shareholders, and the shareholders pay tax on that dividend. So it gets paid, so there's a double tax. Corporation pays tax, send out the money, shareholder pays tax, double tax. An S corporate limited liability company, by contrast, only pays a single layer tax, which is to say, when a corporation, when a limited liability company makes money, it actually doesn't pay a corporate tax. It flows through to the individual's tax return, and they pay on their proportionate share. So, for example, if Cordy owns Cordy LLC and it earns $100, Cordy will pay tax on only that $100 will show up on her tax return. There's no corporate tax. Let me show you an example of the impact of this. And let's assume for a moment that a company owns a company, a corporation or LLC earns $100. In the first column here, it would pay corporate tax of 21%. We're assuming a 21% corporate tax rate. It pays $21, leaving $79 in the corporation to distribute to its shareholders. So it takes that $79, it distributes to the shareholders, they pay tax on it, and so they end up with $63 in their grubby little hands. Contrast that with a limited liability company. It makes that $100, no tax at the corporate level. It distributes the $100. Tax rate's a little higher at the individual level. Let's say capital gain $20. They now pay $20, so they have $80 at the end of the day. So the double layer of tax has resulted in less money in the individual's pocket because of the double layer of tax. It's not everything, but it's just worth remembering. So for example, if you're a company that's simply going to go along and make money, sort of, I'll call it a lifestyle company, go ahead and plan to earn money and then it may be very well worthwhile being an LLC as opposed to a C-Corp and triggering the double layer of tax. But that's not the only factor. And it's not even the only tax factor. Another tax factor, to complicate it, is C-Corps, as shareholders of C-Corps, not S-Corps, not LLCs, just C-Corps, are entitled to what's called the qualified business, small business corporation treatment, may be qualified for this. And, I always say that we spend a lot of time trying to minimize taxes, And we could all have our favorite tax rate. Okay? Capital gains is less than ordinary income. But this one results in my favorite tax rate of all, 0. Yep, you heard it, 0. If you qualify for this and you form the corporation and you sell the stock of the corporation over 5 years later, subject to lots of potential exceptions, the federal applicable tax rate might be 0. Now, there's been some legislation that was proposed last year that didn't go through. It seems to have taken the back burner now to reduce it from 100%, the exclusion to 50%, but even a exclusion of 50% still pretty good. So one of the benefits to having a C-Corp, and lots of venture capitalists pay a lot of attention to this, is that you can get the 1202 treatment. So that's a benefit of the C-Corp. You can also have tax-free mergers with C-Corps and things that you can't have with the others. Let me spend one moment to that's tax. Congratulations.
Just a question on the 1202. Is
Yep.
there a timing on, do you have to file for that? Or is it just, how do you, what you have to hold it? Is that when you're selling the business or what is it?
So you don't have to do anything upfront. Here's the good news.
Okay.
It is what it is. Just it either qualifies or doesn't qualify. You have to, the requirements are that you have to hold the stock for at least 5 years.
Right.
It has to be, it can't be in those excluded businesses that are hopefully on the screen under excluded businesses. And unfortunately, I'm sorry to tell you that you individually can only exclude up to $10 million. You can't, above that, you got to pay the full rate.
Oh, nuts. Okay.
But yeah, sorry.
So it's not like 83B where you have to take an
No.
act.
Correct,
Okay.
correct.
Okay.
Here's, by the way, on the $10 million, if you find yourself heading in that direction, I had a client recently that took the stock, put it into separate trusts for kids, and ultimately, which were deemed to be different shareholders, and ended up with $50 million of exclusion. So if you run into the $10 million problem, Kit, let me know, and I'll get you around it.
Okay. All right. Thanks.
That's the problem I'd like to have.
Yes,
Yep.
I'm doing it sort of tongue in cheek, yes. All right, but cool, all good. But it's a wonderful thing, and you can even roll it over, but that's a different question. Okay, so one thing I hear a lot of people ask me all the time, what about S corporations, which have the benefit of the double tax I just described? I mean, the pass-through tax I just described, and it is simple. I guess the pass-through treatment. S-Corps do have some pretty significant limitations. It can only have one class of stock, other than you can have two classes if the only difference between the two is one's voting and one's non-voting. You can only have up to 100 shareholders. You can only have basically individual and certain nonprofit corporations as shareholders. So you can't have partnerships or entities as shareholders, and only citizens or residents of the United States may be shareholders. So if one is thinking about taking outside money or venture capitalists or those kinds of things, it is unlikely that you will qualify for an S corporation. If on the other hand, you're gonna run a business again for as a lifestyle company, et cetera, then and I don't mean that in a derogatory way, but you're not planning to to take other times, you're gonna run it yourself and then sell it someday. An S corporation may very well make a lot of sense. Other considerations. If you are seeking venture capital, or you know that you're intended to seek venture capital, you ought to just go to C-Corps. Venture capitals will not invest in LLCs. It's just the way it is, for a variety of reasons, which are beyond the scope of this inquiry. But there's a lot of reasons, and so it just just go straight there. IPOs, one has to be a C-Corp to be an LLC. I mean, to do an IPO. But you can always convert later for that, so that's not the biggest issue. I will say, corporations are easier to administer, than the limited liability companies. Limited liability companies can be complex, particularly if an owner is an employee, because you get into some really interesting tax issues there. So corporations are just easier. And the most important thing to remember that I want you to walk away from on this part is that you can, if you can't decide, it's relatively easy to go from a limited liability company to a C-Corp. There's some quirks, but generally, if I started an LLC, I can switch to a C-Corp. I cannot go from a C-Corp to an LLC. I mean, you can do it, but it is cost prohibitive because you got to pay tax to go from a C-Corp to an LLC. So if one's in the position where you don't know, you're better off to be started as a limited liability company and switch to a C-Corp later. So presumably I've totally confused you. Here you'll see this on the in the slides, but you'll see a chart that we provided that has sort of all the benefits and costs of each one. But the bottom line is there is no simple answer. If you're expecting significant dividends or distributions for a period of time, then I would consider an S or an LLC. If it's venture capital oriented, go to a C-Corp. If you plan to build it and sell it after 5 years, I'd think real hard about the C-Corp to take advantage of the 1202 thing, the zero, my favorite tax rate of 0. And remember, if you can't decide, start an LLC and then switch to a C-Corp later. That's my for-profit group. Now, let me let Stephanie and Odette talk about benefit corporations and limited liability companies, if I can.
Stephanie, do you want to start impact investments, what it is, and a general overview? You're in mute.
Thanks, Odette. Yeah, there are investors out there, and there are startups out there that are interested in having social or environmental impact. And if that's something, you have a company that's focused on that, there are special entities that exist. These are at the state level that allow you to recognize that social impact. There are also investors who are specifically looking for companies who are having social impact. And that's one reason you might want to consider these entities. Odette, do you want to talk about the different options?
Yeah, so in general, over the years, the traditional corporate law had two clear distinctions. They made a clear distinction between for-profit entities and non-for-profit. So a company is either a for-profit, which all purpose in life is to go and maximize the profits for the shareholders, irrespective of the impact of their activities on the environment, on society, or whatever it is. You simply need to focus on maximizing profits. On the other hand, we had, or we still have, a complicated structure for non-for-profit that Cordy will talk about, and that's entities that the whole purpose of life is actually to do good for the public, for the environment, or some kind of purpose benefiting the public. But it's not to make money. So over the years, these lines have been blurred, and there's a lot of tension or concerns at the corporate level. Hey, I want to do good, but I'm basically not complying with my requirements to the shareholder to maximize my profits. And that's why benefit corporations, later those LLCs, were created. So what are these things? These are, first of all, these are for-profit entities that are intended to produce a public benefit and operate in a responsible, sustainable manner. And they impose specific duties on directors, and actually not only duties, but also protection for directors when they could want to consider different stakeholders. So I'll give you 3 examples, really interesting ones, because one of them, the first one, actually started here 10 years ago when we had a very, very similar presentation. And there were 3 entrepreneurs that their dream was to collect plastic bottles in developing countries, convert them into plastic flakes, and then sell them as fabric to companies like Puma, Adidas, and others. This was a company called Thread. And they wanted not only to maximize the profits for their shareholders, but also to do good. And the combination together actually was good also for the investors, because they saw the potential benefit from it. 2 additional examples of the clients that came to us. One is a company in the healthcare space that they want to develop over-the-counter drugs for the treatment of opioids, for example. So there was a lot of discussion with these entrepreneurs. Hey, should it be a non-for-profit, or actually it should be a benefit corporation? And a third example is an entrepreneur that approached us a few years ago, and what they want to do is purchase real estate properties in poor areas of Pittsburgh and lease the properties to poor tenants, in order to enable them to provide affordable leases. So all of these are examples of what we can do. Now, over the years, I think there are about 39 states. I know that Stephanie corrected the numbers. She always updates the numbers here. Including Delaware and Pennsylvania, they have adopted legislation that authorize this kind of an entity. Now, there are differences from different jurisdictions. They call it different names, but the concept is the same, actually, that maximizing or being a for-profit entity with some element of benefits. And it can be benefit to the public, environment, whatever it is. Now, leaving aside the whole benefit for these things, from a legal perspective, they can be taxed either as an S-Corp, C-Corp, or an LLC. There is no real distinction between a benefit corporation and a regular corporation. And Stephanie mentioned to me that there are a few cities that, including Philadelphia, that provide some benefit. I'm not familiar with that, but I don't think these are really significant benefits. So that's not something you should consider. Now, let's summarize what are the benefits, and actually let's highlight them. So first of all, it's a great marketing tool. It's actually the benefit corporates, if it's appropriate, can be a tool for sales and improve your sales. You can take Ben & Jerry's, for example, Patagonia. They use it as a marketing tool. It's from the entrepreneurs, especially when we're talking about young entrepreneurs, it's really important for them to have a strong commitment to social purpose or any other purpose. So this is a tool that enables them and protect their directors to manage a company for good and not only for profit. And just an example for the flexibility it gives you in the sale of the company, when you want to sell the company. So you have 2 bidders, one has a better proposal financially, but the other one is better for the employees and other purposes. So if you're a pure for-profit company, the consideration that you should give to the employees or the environment, there may be some importance to that, but that's not the punchline is the money. And for a benefit corporation, you have other consideration that you can take into account and actually give you the protection, the legal protection. Now, David and I are always concerned when people tell us, hey, we want to form a business and hey, this is for profit, but I don't know, it's not really for profit. So we are a little bit suspicious, and more important, not us, we're not the important people, the investors will hesitate because it kind of says, hey, you're not going to maximize my investment. What am I going to do? So it may be important for, let's say, impact investors. There are a lot of funds that invest in that, but if you take the traditional VCs, they may be very hesitant to do that. And there's a little bit legal uncertainty. There's more, but there isn't really case law about that. And there are no tax incentives. And what's more important is there is a reporting and disclosure requirements, and not every company that is in the space really complies with this, but that's another layer of complexity. Now, apart from the benefit corporation, there is, people talk often about a B Corp, and I'll talk about it I don't want to confuse you too much. But B Corp, you should know, it's like a certification. It's like a certification to lead certification for real estate properties. It's just saying that you're acting in a certain way that is good for the environment or whatever it is. So it's not a legal entity. It's just another marketing tool, basically. And it provides a laundry list of requirements, and it's a little bit complicated to comply with them. So I wouldn't start with this, or I won't advise an entrepreneur to enter into this unless I really think that this will benefit them for other purposes. Just again, the advantages for this, it's commitment to the social purpose, and it may attract some types of investors, but the main disadvantage is the stringent requirements and it's burdensome reporting. Cordy, I think the stage is yours. Just before that, any questions about it? No.
Okay, I'll start on the nonprofit side. So what's the next slide? So nonprofit corporations have some of the advantages of the corporate form that David mentioned. There's limited liability because it is a form of corporation. The main benefit of the nonprofit corporation is that it has the ability to qualify for tax exempt status. Now that's not automatic. You have to apply to the IRS for that and make and comply with a lot of rules. But tax-free, you think that's great, right? But the tax-free status comes with a lot of strings and limitations on how you can operate and what you can do with the funds generated from your activities. It also is subject to a great deal more public scrutiny because as a nonprofit, you have, for example, you have to file information returns like that's similar to a tax return every year that are available to the public to see. And there's oversight by the state attorneys general that want to be sure that you are in fact operating in the public interest. And then also kind of probably most significantly, there's limitations on distributions. So nonprofit, interesting, is a bit of a misnomer. You can make a profit. You're just limited on what you can do with your profits. But that's a really key point here, which we'll talk about in some of these next slides. So next one. Oh, I think you skipped a couple up to that org chart one. There you go. So tax exempt organizations actually take a lot of different forms. When people think of a tax exempt organization, they most often think of a 501c3, which is commonly known as a charitable organization. That's one you think about. I can, get contributions from the public and they can get a tax deduction. And that's all of the entities that are on the left side of that org chart that you see there. And there's all different types of 501c3 organizations. The ones on the right side are things like trade associations, social welfare organizations. There's other forms, again, all tax exempt, but they don't get tax deductible contributions. Okay, next slide. So 501c3 organizations, as I said, are thought of as a charitable organization. They have to have purposes that are charitable, scientific, educational. Those are the primary categories. And there's a lot of regulation on what that means. But as a C3, that's the most favorable tax status. As I said, you get tax deductible contributions and you're exempt from federal income tax. But with that comes the most stringent requirements of all of those types of exempt organizations. And we'll talk about a couple of those. Next slide. Another thing, and we won't spend a lot of time on this, but you'll remember from that first slide that had the org chart of all the different types of C3s. There are many different types, and you have to be thoughtful going in, well, which type would I fall into? Because when you apply to the IRS for tax exempt status, you essentially have to know that, can I qualify? And the goal is typically to qualify as a public charity. So because if you can't, then you're put in this default private foundation box where you're subject to even more rules than most C3s are generally. So what's a public charity? And their public charities can, by nature of what they do, a school, a church, a hospital. But the one that you're probably most familiar with that you think of is I get donations from the public. So the United Way is a very easy example. Yeah, they get donations from the public to support what they do. You can also be, this is described here in the slide as a gross receipts organization. It can be an organization that receives fees for services for what they do, but it's a charitable activity. So their revenue is from those fees for services. But the main idea is that the financial support comes from a broad base of the public. And that's what you need to show to get that public charity classification. But all 501c3 organizations are subject to certain core requirements. They have to satisfy organizational and operational tests. And this is all fleshed out in the application that you file with IRS to seek tax exempt status. So the organization has to be exclusively for charitable purposes, for purposes that qualify under the IRS definition of what charitable is. It also means that there can be no private inurement, which we'll talk about a little bit. And that's the piece that limits distribution of earnings to the founders, the directors, and officers. It can't engage in any political activity and a limited amount of lobbying activity. And then this last bullet is the other one that's important, is that its assets have to be devoted for charitable purposes in perpetuity. That essentially means that as soon as an asset goes into that corporate box that has 501c3 status, it is permanently imprinted with the charitable purpose. So if that organization ever wants to sell the assets, they can sell the assets, but they have to get a fair market, at least a fair market value price for them. And then those proceeds are permanently imprinted with a 501c3 purpose. And so they can't be used to pay out compensation, for example, to insiders, to founders, directors, and officers, except for reasonable compensation, a reasonable salary, for example. So that's the other important concept here. Next slide. So again, just a couple words about what private inurement is. Typically, it's excessive compensation. It can be, and this is limited to insiders of the organization. Private inurement is a condition of exempt status. So if private inurement occurs, exempt status is lost. So when a nonprofit is set up, you need to be sure that any arrangements with insiders are completely arm's length and that any compensation that they receive is reasonable. They can't they can't benefit from the profits that the organization creates aside from that reasonable salary compensation. Then the next slide is about private benefit. This is a concept that applies more broadly. It's not limited just to insiders of the organization, but it essentially says that the public purpose of the organization has to outweigh any private benefit that it generates. Okay. And then there is this concept also of excess benefit transactions for nonprofits. So what happens if any of these transactions happen? So what if someone receives excessive compensation, someone that's an insider? And essentially, there's regulations that say that if these types of transactions happen, there is an excise tax that's imposed on the person that received the excess benefit. And that can also be imposed directly on the individual directors and officers that participate in the transaction, knowing it was an excess benefit. Okay. So that's another kind of key regulation that ties to how compensation flows in the organization. And then another concept just to introduce is unrelated business income. So just because you're a 501c3 doesn't mean you can't potentially be subject to income tax. This is a concept that says if a 501c3 organization engages in, regularly carries on a trade or business that's unrelated to its core charitable exempt purpose, it actually generates taxable income from that. And the income from that activity is subject to corporate income tax, just as a C-Corp would be. And then if that revenue becomes too significant, if it becomes substantial in relation to the overall activities of the organization, it can jeopardize exempt status. So, I mean, that's just, there are many, many other rules that we could talk about, but just hopefully that just gives you a flavor of all this, the strings that come along with 501c3 status. So it's a great thing, but it's important to understand all the strings that come along with it before you head that direction. So.
Thanks, Cordy. So, questions for Cordy. Let me just sort of, so in sum, if you're doing a corporation or you're for-profit, straight for-profit, we want to lean toward an LLC, C-Corp, S-Corp, and the analysis I talked about. If you're thinking that there's a benefit, public benefit to it, and you think that would be helpful for your business, then you think of Odette, and you think of benefit corporations, benefit LLCs, right? And think, does it make sense to take on that additional burden of reporting and otherwise, and et cetera, in exchange for that benefit? And there is a benefit, right? And you can take into account those kinds of things. If you want to go to the extreme and say, okay, you know what, I'm not planning to make any money out of this thing, and I can't make any money out of this because I can't, for all the reasons that Cordy said, I can't have really investors because they're not going to get any money out of it. There's no, I'm going to take foundation money or contributions. I'm not going to, there's no upside. I can't sell it and make money, but I really want to do that. Then you think of Cordy, and you think about a nonprofit kind of approach, but that's a different universe. As far as, for example, investors would not want that because they can't get a return on your investment. So when you're thinking about formation, think about those three buckets, which is why we each did it separately, because it really just emphasizes the point.
So I just want to say this too, that I'm putting my business hat on. This is more focused on legal issues there, but usually Stephanie and I will try to talk people who out of saying, oh, I'm going to form a nonprofit, because they're usually doing it for the wrong reasons. And because they think, because it sends a message to the public. There's all sorts of different ways of doing that. And the one thing that Cordy sort of touched on too, but of the three, let us just say, although God forbid, let's just say you've been working on your business for a while, and then all of a sudden now you decide that you know what, it's time to move on. This isn't paying my student loans, and you want to shut it down. And the degree of difficulty or what's involved in just going out of business. So I know it's very different for nonprofits. So maybe Cordy, you can start with that.
Sure. Yeah. So if you just want to get out of it entirely, there's options. I mean, you can find another nonprofit to kind of take it over, right? But you're not recouping any money from that. I mean, because as I said, everything that you put into it is forever imprinted with that 501c3 charitable purpose. So perhaps you can find another nonprofit to take it over. That's possible. But again, you're not getting any profit out of that as you would if you if you sold off your company, for example. Alternatively, you could dissolve the entity, right? In which case you still have to find a place to put the assets. That's another charitable entity. So that's just the, and I don't know if your mind was going anywhere else with it, Kit, but that's kind of the gist of it, is what it has to stay C3 in some way, shape, or form.
Well, I know when the Visiting Nurses Association shut down, because when they started out giving free flu shots at the pharmacies, that was their primary source of income. It took the president over 2 years to wind it down. Whereas, David, let's just say we have a startup that's gone through Alpha Lab and Gear, and maybe it's gotten some angel investment, and now wants to shut down. Just realize it's not going to amount not going to be the fast growth thing they had hoped. What's involved in that?
Yeah, so, in that case, a couple of different things. If there's some assets there, then you can sell it off to a third party. So you can sell the assets and distribute them to the owners, shareholders, or members. If there's truly nothing left, which often is the case, there's just no assets, then you would basically shut the doors and dissolve, and there's nothing to distribute. Or even, and if you just have cash, you would just basically dissolve it. So I agree with you that it is an easier process in a nonprofit, in a for-profit, than a nonprofit to dissolve it and end at the end of the day. To me, but I agree with you, Kit, that doing nonprofits, I think you're right. People, it's something worth thinking about. But the two questions are: did you want to make money from it? Because if you didn't, if you want to, then it's clearly not the right place. And two is, where are you going to get your money? If you're thinking about investments, it's not the right place. But if you're thinking about foundations and raising money through contributions and those kinds of things, then you ought to think about a nonprofit, because people can. I'm not sure we talked about it much, but the point is that a nonprofit, people can also make donations. Hopefully, if you do it right in a 501c3 on a tax and get a tax deduction for it, whereas you certainly can't do that with respect to a for-profit. So it's got a place, but not always the right place.
And benefit courts are pretty much the same.
There's no charitable contributions for benefit corporations. For tax purposes, one should think of benefit corporations as exactly the same as a C-Corp and an LLC.
Okay.
The sole benefit is that you can take into account the benefits when you're making decisions, and you can't do that in a traditional C-Corp or LLC.
Okay.
One other question. If you start out as a for-profit and you decide you're not interested in continuing it as a for-profit venture, is it possible to convert a for-profit into a nonprofit if you wanted to move into a charitable organization?
Yeah, you would. Cordy, you should answer this probably, but you would. That's I'll say it's much easier, much like my C-Corp and LLC analysis. The analogy is, I think it's a hell of a lot easier to go from a for-profit to a nonprofit than it is to go from a nonprofit to a for-profit.
Yeah, I agree with that. But it also is likely to result in a taxable event, though, for the corporation. I believe it's treated as a dissolution, right, before you convert. So you'd have to think about the tax consequences of doing it. It is definitely easier, but it doesn't mean there aren't financial impacts from it.
Totally agree.
Yep.
Yep. All right. Anything else on that? I put up the next slide, which is simply, I'm often asked what state should we incorporate in, so let's just hit it, and we don't spend a lot of time on it. But a lot of people go to Delaware, and they go to Delaware. Actually, they don't physically go to Delaware. Nobody wants to physically go to Delaware, but they incorporate in Delaware, and that's because it's predictable. The world, everybody for lots of historic reasons has incorporated in Delaware. It's got a huge body of law upon which which creates predictability. It's actually got its own business courts, so it's an attractive place, particularly for venture capitalists. So that's one. Predictability is a big one. Cost is important. You don't want to go somewhere which is expensive. As I say, it's attractive to capital. Delaware is one of those. But there's no reason to go to Delaware if you're just going to operate, for example, in Pennsylvania. If you're simply going to be operating in Pennsylvania without any additional investments, then you'd be in Pennsylvania. So my general view is, if you're going to attract capital, then I would be going to Delaware. If you're going to operate in Pittsburgh and Pennsylvania, and you're going to do that sort of things, then stay in Pennsylvania. And that's more broad than that. If you're going to, putting aside, I was going to broaden it and say, if you're going to be in Nebraska, be in Nebraska and do it there. But I would check the tax rates first.
Okay, David, we have a question in chat.
Yep.
Can you explain the entity relationships that can exist between a 501c3 and LLCs or other for-profit entities? Which I think what they mean by that, and Cordy might have touched on, he said the 501c3 can make profits, but it doesn't necessarily, can they own a for-profit business or have affiliate or a subsidiary and vice versa? So can I, as a corporate, have a 501c3, that type of thing?
Right. So I would say if you are a nonprofit, if you are a tax exempt organization, you can have a for-profit subsidiary to engage in, for example, some activities that might otherwise be unrelated business taxable income or that just wouldn't even qualify, as a charitable activity. So you absolutely could. You could have a for-profit subsidiary. In that case, the C-Corp is the key. It's often the key form that you're looking at because that serves as what's known as a blocker for tax purposes. It kind of isolates the for-profit activity in a separate corporate box. If you use the LLC form for tax purposes, it's treated, it passes through. And so that there can be a risk there. But a nonprofit can have for-profit subsidiaries, but you have to be careful how they're structured. And there can be relationships with for-profits as well. But again, the structure, the devil's in the details, and structuring it appropriately and making sure things are arm's length and fair market value. But the reverse is also true. It's very difficult for a for-profit to really have a nonprofit subsidiary. That nonprofit will have a lot of trouble qualifying for tax exempt status if it is controlled in a certain way, or you can't really be owned by a for-profit. It can be affiliated with it. So for example, you'll see corporate foundations, right? They have an affiliated foundation that they fund, the corporation funds, and that engages in kind of the charitable initiatives that the company's interested in. But they're not a combined balance sheet. Those C3 assets are just C3, right? And the control happens typically because the people that serve on the board are the corporate executives. So hopefully that answers the question.
Cool. We spent some time on the entity, what kind of an entity, what the structure would be. Let's spend a moment, if we can, on the founders themselves and the relationship intra-founders. And what we do with that. And the first order of business is to ensure that our founders have a right to enter into the deal, and that's into the new entity. And so there's some sort of, I'll call it due diligence roadblocks that need to be thought about. And I raise this because, and I'm emphasizing it because it's a step that I think people sort of skip. And then you don't realize it until it's too late. So I'm asking people to do it now. And the answer is when your founders are looking around at each other, think about forming this new entity, look around and say, do I have any obligations, contractual or otherwise, to third parties that are going to affect my ability to enter into to form this new entity or be involved in this new entity? So for example, have I signed a non-compete or an agreement with a former employer that contains a non-competition or non-solicitation agreement that will preclude me from entering into this deal? And people think, well, I didn't, but you may very well have. Have you signed a confidentiality agreement? Have you agreed with your former employer that you will keep all information of that employer confidential and not use it for any other purpose? And you're bringing some of the confidential information to this new company. If you are, that's a problem. Are you still a board member or an officer of another company with fiduciary duties, such that you'll have competing fiduciary duties both to the former employer and now this new company? If so, that needs to be dealt with. And probably the one that gives me the most indigestion is, did you sign an intellectual property assignment and assign any intellectual property to a third party, such that they now own what you think you're contributing into the new business? And that can be simply an agreement, because I mean, most of the time when you go work for a new employer, you sign an intellectual property agreement that says everything I create while in the course of that employment will be owned by the employer. We're going to talk about the fact that I want you to do it in this one too, right? But have you signed that? And then are you then going to bring that IP into the new company? Do they have a policy about that? So as an example, we often have, we have our professors forming new companies. Well, the truth be told, they actually don't own the IP, right? It's actually owned by the university. So we license the technology from the university, and the professors are assigning whatever they have, but they truly, most likely don't own it because they've already assigned it. Well, similarly, people who are coming from, call it Uber or other companies, Google have signed intellectual property. So that's the first step, which is let's make sure our founders actually have a right to enter into the deal and form our new company. Then we have to think, okay, so what's the relationship with this company? So one is you need to think about, okay, we're going to sit around, we're going to do this thing. What role is each founder going to have going forward? Is somebody going to be the CEO? Is somebody going to be the CTO? Is somebody going to be the, going to be a consultant? What role are they going to play? And we want to make sure that we've thought that through. Are they going to get paid? If not, are they getting equity? Some people can afford it. I mean, I have some people, founders that, can afford to go a couple of years because either they have some money stashed away or mom and dad are paying for it or something like that, and others that need to get paid. So the most important thing is to have an open and honest conversation so your expectations are the same. Third, we need to have our founders sign intellectual property. And this is both now and going forward. They need to assign whatever intellectual property they have into the company, and we got to make sure that they sign a consulting or an employment agreement going forward so that what they create going forward is also owned by that company. Now, I have, Odette and I have lived through things that did not work so well because of exactly this. We have one company that did not, notwithstanding what they were supposed to do, have their principals sign consulting agreements, and there was a dispute later as to whether things that they created was owned by the company or not. And we have issues with them signing IPs because of getting upfront. So make sure what's in the company is owned by the company. Fourth is, are we going to have our founders sign restrictive covenants? That's non-competes, confidentiality, and non-solicit are the principal ones. Non-compete. If Odette, Cordy, and I are going to start a new company, we get started, and a month later, Odette says, "I really don't want to do this because I don't particularly like you, David. I'm going to go work for with Kit for a brand new company, compete with it." That's not something we want to do after we've already got capital and everything else and devoted a whole lot of time to this. So I want some kind of non-compete. I want to make sure that Odette is going to take my employees and customers when he leaves the company. And I sure as heck want to make sure he's not going to take the confidential information and trade secrets from my company, right? So I got to make sure that all those things happen. And so we can have our founders sign what we call restricted covenants, those three items. Now we can quibble about, and we will, about how long that non-compete is. Is it 1 year, 2 years, 3 years after they leave? Is it based upon and what's the scope of it, and how broad is the business non-compete? And those are all things that you need to think about in framing that non-compete. But the answer is we need to make sure we have non-competes. Let's skip the others. 1 second. Let's skip one. 1 second. Give me 1 second. Yeah, we're going to talk about the amount of equity, but while I'm there, I want to talk about the employee. We're going to talk about how much equity each founder gets. But let's spend one moment on the nature of the employee equity, because I talked about Odette leaving and him not competing and that kind of thing, but also he's also going to walk away with the stock. So it's really important that our founders' stock vest over time. And we can talk about how much, but what I mean by vesting is that if they leave after a period of time, they lose some of that stock. The company has the right to buy it back for close to nothing. And so, for example, if I'm going to use Odette as the example again, if Odette leaves after a year, he should probably have less stock than he has if he leaves after 2 years, or if he loses after 3 years. So our founders should have vesting on their stock. Really important. How long that vesting should be, it's all over the map. 1 year, 2 years, 3 years, 4 years. That most common I see is 4 years. And at that point, I want the right to buy that, to have that stock back for them. I will tell you that when people put money in, whether it be venture capital or otherwise, they're going to require that the founders vest their stock. One of the advantages I find of doing it up front is that when the money comes in, you say, I've already done it, because the venture capitalists may require it to be more aggressive than we're doing it. So maybe you get a leg up on it and do it that way. One thing that tends to be kind of controversial, and let me say the part of the economic reason for this is because I need that equity back because I'm going to give that to somebody else, and I can't. And one of the things that makes a company very hard to invest in is if a whole lot of stock is held by a non-contributing former founder. That's just that investors and things want the money in either people that are driving the company forward or putting money in. And so a huge slug of stock in a non-contributing founder is often a problem. To that end, we also have provisions sometimes that give us a right to buy back founder stock even after it's vested. So they wouldn't just lose that, you would buy it back at fair market value. And the theory is that one should have the benefit of the value of the stock from the time you come in to the time you leave, but not from the time you leave, because that way, because you're not contributing to it at that point. So we would have a right to buy it back at fair market value. Now, some founders say, okay, well, I don't want that because I put my blood and sweat into this thing. I got to start it. I'll be darned if I'm going to lose my stock and not get any of the upside. So sometimes we compromise. We say, okay, we'll buy some of your stock back, but you're going to keep, you're not going to have the amount that you would have had had you stayed with the company. So there's that kind of thing as well. So you ought to think about not just vesting, but also whether there's a right to buy some of the stock back at fair market value when people even vested stock. Questions about that?
No, there are no questions on that, but I hate to keep going back. There's one question that came up a little bit later. Any concerns with using standard NDA template letters generated through paid service like Rocket Lawyer?
So say that one more time.
Any concerns with using standard NDA template letters generated through paid service like Rocket Lawyer?
I need to see the NDA to comment on it. So, I mean, if let me suggest this. An NDA is an NDA, but it's not. NDAs aren't, not all NDAs are equal. So that's point one. Point two is that NDAs sometimes don't have, they have terms on them, and NDAs should not have terms for trade secrets. So one needs to be careful in what NDA they use. My instinct is that if you are using a lawyer and you use company counsel, you should use their forms. And they have, I mean, we can print off an NDA and get you an NDA as part of a startup package. And most startup lawyers can do that. So if you're working with a lawyer, I would suggest you get their NDA. If you're bound and determined to use an NDA that you pull off one of those sites, my recommendation is that you do more than that. But if you really want to do it yourself, then you do two things. You get a few of them, do what I would do. Get a few of them and compare them and see what they have and don't have. And two is read a couple articles to figure out the gotchas. But I think you're better off if you're hiring a startup lawyer, which you should get it from them. And the most cost inefficient thing to do is hand a lawyer somebody else's form and say, okay, what do you think of this one? It's much easier for me to use mine, frankly. Does that answer the question?
I didn't ask it, but Samir did answer your question.
Yes, no, maybe so. Okay. All right. Going back. So the next question is, okay, now that we talked about vesting it, how much we're going to give people? And that's a great question. So when you're thinking about it, think about number one, as you think about how much people are getting, remember you're going to get diluted because we're going to take in additional capital. You're going to have adopt employee incentive plans. So we're going to dilute people. So think about that. Make it simple. I mean, based upon time, based upon, I've seen people do some really complicated things of trying to do it based upon number of hours served or et cetera, and that gets really complicated. So try to keep it simple so you're not trying to second guess it. I already mentioned, but I'll say it again, err on the side of protecting those who are providing value going forward. The most common way to do this, or not the common way, but the people like to do is say, okay, well, there's 4 of us. That's easy. Each of us can get 25%. Not so much. That's the wrong approach because everybody has different values going into it. Not everybody is the same, and so that while that sounds right, it's not the right answer. And my last comment is, if there's 2 of you, another instinct is to make it 50-50. And that's difficult because it really, who makes the decisions, right? And how are you going to make those decisions? So you got to, and it creates the potential roadblock or deadlock because one of you may want to do something, the other one doesn't, then what are you going to do? So there are solutions to this. You can implement you can do the 50-50 and then have a shotgun, which is basically a right to buy each other out. One buy the other one out if you can't decide. You can decide on a third-party director. So you have a board of 3, and you get somebody else to serve in the role. Or you can agree to an arbitration. But I'm not a big fan of arbitration for what's largely business decisions. So the first 2 are the best. Generally, I'm not a fan of this. I've probably come off my that as hard if you're, for example, about to get a funding, and so it's going to get broken pretty quickly, right? In other words, if you're about to take IW money and they're going to put money into it and they're going to put a board member on or something, then I'm not going to get too excited about it. But if it's going to be a longer term plan, then I'd probably try to avoid the 50-50 if you can. So when we do the thing in a couple of weeks, we will workshop. We're going to go through Frank Demler's pie chart, which is a nice way. It's not perfect, but it's a nice way to have people think about how much equity people should get. And it turns out that it's actually a pretty good little system. And as I say, it's not perfect, but it's rational. So let me run through an example here, and then you'll see when we do the workshop how it applies to you. And let's assume for the moment, and what does it evaluates the related contributions and weights them. That's all it does. So let's and it breaks it into five concepts: idea, the person who had the idea, the person who has the business plan, domain expertise, commitment, risk, and responsibilities. So this is those 4, and it weights those 5, and it weights the contributions of each founder in each of those. So let's use an example of, let's say we have the inventor. He's the leader in the domain. He's the person, or he or she is the person who came up with the idea. Then we have, quote, the business guy. That's the person who's in the business, has a little industry knowledge, is jumping ship, is really going to run the business. The technology, who's the inventor's right-hand person, and the research team member, the person who has no future in the company, just was assisting the inventor in the lab, right? So let's see how much each of them. And so if you look at the thing, you say, okay, well, take my founder. he certainly had all of the idea. So, I mean, so he gets a 10 in that one category, right? But he's also not going to stay with the business. He's going to stay at the university, and he's not going to have any responsibilities going forward. So he gets 0 in those 2 columns. He might help a little bit in the business plan, so we'll give him a 3 out of the 10 for that. And he's got domain expertise of 6, right? Contrast all the way to the end of the founder, of the researcher. He had a bit of the idea, a little bit, nothing on the business plan, some domain expertise, no commitment risk because he's staying at the university, and no responsibilities going forward. So he gets a whopping 4. The business fella, well, our new CEO, has some of the idea. He's working heavily on the business plan, so that gets an 8 on that. Relatively modest amount of domain expertise as they learn about it. Commitment risk is relatively high because they're actually taking the business, taking the job and going forward and giving up other opportunities. So they're getting a 7, and lots of responsibilities going forward. They're 6. So you weight those. And then you weight the importance of each one of those, and that's pretty hard, but you can do it. And we've weighted the idea pretty high. The business plan, probably a little less because I can basically go, I mean, I hate to say this, but you can hire people to help you with the business plan. Domain expertise is pretty important. Commitment and risk is pretty important. That's somebody who's willing to give up things to go do this, and responsibilities going forward. And then you multiply them. So you get your little abacus out and you multiply them out. The weight that we gave times the thing, and then you add them all up, and you come up with the total points. So let's see if that little process worked. And what you see is, okay, well, we got our founder. He got about a third, 33%. He got a third of the company. The inventor. The business person got 44%, the one who's taking the risk and jumping. The technologist, 16%, and my researcher got 6%. That's not far off. That's a pretty good, when I look at that, and you can quibble about it, but that's pretty good as far as the relative weight that I would expect for those kinds of positions. So what this allows, this process is not perfect, but what it does allow is a candid conversation and a means for the founders to sit around and talk about it. It's a really hard conversation. I will tell you that what's I've seen more of in the recent years is the relative imbalance and difficulty of, for example, people in the universities and the senior professors and doing with that, and this helps with that because that dialogue, as it helps with that discussion because you look at it and point to it. If you find yourself in that situation, you should also look for others to help you think through that as well. Whether lawyers can help you with that as well. Question about the splitting the pie. Okay.
We have
As you go-
5 minutes left. I'm just looking at the clock.
Cool. I can talk really fast. Actually, that's cool. Operational. I just want to when you're thinking about the relationship between the founders, here's some things to just think about as you're going through it. One is who are the directors and officers going to be, and who's going to appoint those officers and directors, and how many they're going to have. Are you going to have 3 board members, or 4 board members, or 5 board members? Who's going to have a right to be on the board? Who's going to appoint the directors, and who are those directors? Who are going to be the officers? The president. As you think about this, many decisions you do by majority, but are there some decisions that should require a supermajority? So, for example, let's suppose for a moment that there are 5 founders. How many founders should it take to, and break my rule and they all have 20%, right? How many founders should it take to sell the company? 3 of them, 4 of them? How many should it take, right? And so think about what are there any supermajority? In order to raise capital, should it take more than a majority or just a majority to make those decisions? And then restrictions on transfer. It would not be funny for Odette and I to enter into a 50-50 company. We go through it, and then I wake up the next day and he's transferred his stock to somebody who I'm not particularly fond of, right? So there needs to be restrictions on transferability, particularly among founders up front. You can have company rights of refusal, you can have other things, but I think you basically want some prohibitions on sale of the stock or transfer of the stock. We're going to spend one moment on employees because that's, when you form the company, you hire employees, and we do a whole other thing on employees. But I do want to make sure that the issues regarding the employees are similar to those of the founders I described, which is I want to make sure I have intellectual property assignments, make sure we have make sure that we own what they create while they're employed, make sure we have restrictive covenants, make sure so that the employees aren't leaving and stealing our confidential information or competing or soliciting, and make sure they're at will so we can fire them, and those kinds of things. Employee equity, I'm not going to go through the details of it, but I will say that the most important thing I get asked a lot is how much employee equity should we give? And the answer is we should adopt a plan with the amount of equity to give employees that's necessary to attract and retain talent. And that's it, no more, no less. So some people like to create large option pools because they think it's cool or it's the right thing to do or they like to do it. That's not right. There's some employees who it doesn't make, you're paying a fair compensation. It doesn't mean anything to them. You shouldn't give them equity. On the other hand, some positions it's really, really important. It drives incentive and you really want to give them equity. So my message here is to be careful in what equity you give to employees. Be careful, turns out I only can give out 100% of the company. If I give out more than 100% of the company, then I go to jail. So, there's a cap on how much I can give. So I like to be cheap with equity. I'm not saying you do give it to employees that require it, but don't be crazy about it. And if you're looking for a rule of thumb in growth technology companies, high growth technology companies, a rule of thumb is around 15%, 10 to 15%. And that's it. Questions? Discussion?
Okay, so while if you're thinking, we have time maybe for one or two more questions very quickly, but a reminder that on Thursday, the 10th or 11th, we are having the workshop. If you are interested in participating in the workshop, on the registration page, what you'll see, you have to sign up for it and then send Stephanie a brief summary of what the business is about, because she will try to match up the law students with what your type of business is. So you will be meeting, we'll go into breakout rooms, you'll be meeting one-on-one with one or more law students, sometimes you get multiple, and bring your other team members with you if you have team members, because sometimes, as you just heard David talking about, these are founder decisions. And so it's good to have your potential founder or partner there with you so that you both understand what's involved and participate in making the decision. So what else, Stephanie or David, do I need to talk about, or do we need to talk about the next session?
I think that's it from my perspective. Stephanie, we'll probably maybe post a couple materials before that, so people can look at it before then, huh?
Yeah, they had posted, I think, the questionnaire, but we may want to look at it again just to make sure we don't want to add anything.
Yep. So I'll look at that before then,
Okay.
and make sure we post that.
So we do have a question, David. I assume distribution of the pie with investors is predetermined, and the result is more or less what you're dividing amongst the founders.
Yeah. So good question. What I was describing is just among the founders. When you bring the investors in, you will negotiate with the investors how much equity they get, and then all the founders will get diluted proportionately. So if Odette and I each have 50%, and then we bring an investor that gets 20%, Odette and I are now at 40% each, and the investor has 20%. So what I was describing is solely among the founders, and we're all going to get diluted proportionately when the investors come in.
Okay. And we gotta, this is very helpful. Thank you for organizing from one of our participants. So,
Well, thank you. It's been a pleasure. And thank you to, thank you for my, to my co-presenters today. with
Yes.
having some other
that was
people.
helpful. And one last plug is next month, Jess brought it up, is going to be Global Entrepreneurship Week, whereas we as universities celebrate entrepreneurship around the world. And we will have our last Start Smart of the season then, and it's going to be building your team, not so much on your co-founders and founders, but building your professional team. This would be advisors, board of advisors, and your most important first decision is how to find the right lawyer for you. And Stephanie and I are going to be more lenient in that. And that's the 15th of November. Okay.
Thanks, Dave.
So more great comments in there. You all been awesome. And so I hope to see you all, many of you, in 2 weeks. By the way, you're under no obligation to form the company after you go through this. You should do that when it's appropriate. But it's just now when you go to do it, you'll be an informed consumer. You know what it is you need to do. So